Alright, so first let's quickly see again what cyclical emphasis is. What is the relationship between US dollar and gold? If US dollar is going up, gold is going down. If US dollar is going down, then gold is going up. Very simple correlation between the two of them. And then we have the relationship between gold and bonds. So when we talk about the relationship between gold and bonds, let's see that. So gold has been going up and bonds were just consolidating, and then as gold went up, bonds came down. So as gold actually went up, bonds were coming down. So if the bonds are not giving good returns, and if the bonds are not stable in nature, so if the economy is not stable, then the bonds will not be stable, right? So if the economy is not stable, or then what happens? The gold prices go up. So similarly, if the bonds are not giving good returns, then gold is going to go up, and vice versa. Coming to bond market and the spot stock market. So let's talk about the relationship between the stock market, basically the economy, and the bond market. Ideally, in the normal business cycle sequence, the next switch in markets is from the bond market to the stock market. Murphy argues that this is because for the first time since 1930s, actual deflation has become a threat and has upset the previous balance between interest rates and stock market. Nevertheless, a plot of the ratio of bonds to stocks, as shown in 29.6, shows definite times when one has the advantage. So look at this, S&P 500 has been going up, long-term US interest rates has been going down. So interest rates have been going down, because of which the S&P 500 index was going up. This suggests that the bond to stock ratio has excellent history in the timing of the market. Okay. From after the 2003 stock market bust, stocks outperformed bonds handily. However, in November 2007, almost at the peak of the stock market, the ratio turned up, suggesting that stocks be sold in favor of bonds. And again, the bottom of the stock market crashed, the ratio swung the other way and suggested a return to the stock market again. This suggests that the bond to stock ratio has an excellent history of timing in the market. Now, if we talk about the US dollar, which is their currency and their stock market, the final analysis is to return to the beginning and to see how the dollar and the stock market have interacted. The dollar usually leads the industrial raw material market, which in turn leads to the bond market, which in turn leads to the stock market. So, raw material is going to affect the bond market, and the bond market is going to affect the stock market. So, by connecting the loop, nothing is accomplished, because there seems to be only a slight relationship between stock market and the dollar. This may have changed also, because figure 29.7 shows dollar now has an excellent timing relationship with the stock market. So, US dollar has been going up, stock market has been going US dollar has been going down, and stock market has been going up. US dollar again was going down, and stock market is going up. So this is the relationship between the stock market, or the S&P 500, and the US dollar. This may have changed, because figure shows, okay, the dollar to stocks ratio gave a buy signal for the dollar and a sell signal for the stock market in December 2007. Let's see, December. Okay, this entire chart is for July. So have they given us a picture? Let me see that. Figure 29.7 dollar, the dollar to share 29.7. No, so they haven't given a picture, but okay. All right. So anyway, you just understood the relationship between the dollar and the stock market, right? They have an inverse relationship, and that is something you need to keep in mind. A little a little disconcerting right now is a signal occurred again to buy the dollar and sell the stock market. Okay, so I understood what happened. This particular table, there has been a mistake, there has been a printing mistake. This will obviously not, every month can't be just July. So they just forgot to change the months, which is why we were getting confused when we were reading this. But it is fine. That's okay. So anyway, so if you just ignore the months, and if you just look at the dollar to stocks, you can see that here there was a buy signal for S&P 500, since it broke from the trend line, and this was a sell signal of the US dollar, right? I'm sorry, I literally said the opposite. This particular area where the ratio dollar to stocks went above the trend line, which broke the trend line. So obviously, what is this ratio? It starts with dollar, right? So this shows that dollar is going to go up, and eventually it did. If dollar has to go up, that means that the S&P 500 has to go down. All right. Implications of intermarket analysis. From the previous analysis, it appears that around 2001, the investors should have been looking at the raw materials market and the stock market because both markets appeared favorable. The raw market material stocks would likely have been the best investments. The signals given by the various ratios are usually long term signals in the sense that they are operating within the business cycle. They are neither trading signals nor mechanical signal. Their purpose is to perform the investor in certain markets to invest solely from the way marketplaces are behaving. When certain sectors become strong, they tend to remain strong, just as when a trend begins, it tends to remain. Eventually, these ratios will suggest changes in the investment mix, but only rarely do they err, and often that miscalculation comes from the investor impatience and greed. Okay, let's talk about creating an array. Now, what exactly is creating an array? It is basically to draw a an array which includes the classes, and it basically tells us where we are supposed to invest and where we are not supposed to invest. One method of consolidating all the relationships mentioned earlier and lessening the difficulty in keeping straight the current situation with these asset classes is to periodically draw an array that includes the classes and gives a hint as to where investment assets should be most likely placed. In table in an array of the current readings of the preceding charts in their summary. So if you look at this, you can see that you are creating an array and you are seeing whether you want to buy or you don't want to buy. So you have dollar, gold, stocks, everything, and we can see relative asset class strengths, and you can mark yes, no, and how many yeses were there and how many no's were there, and according to that you can make trading decisions, right? The array suggests that investment should be half invested in dollar assets and none in the bonds market. Mm, Once again, leaving a split between gold and stock market with more emphasis on the stock market. So the point of this exercise is determining what asset classes have the most promise during this business cycle and so on. Let's see what the law of percentages is. A relative loss of 20% can be made back with a relative gain of 20%, but an absolute 20% loss requires a 25% gain to break even. So you know the difference between relative and absolute. I'm not going to go into it, but this is basically known as the law of percentages, right? You need to make 5% more in order to just come to break even. Okay, in investing it suggests that all absolute losses must be kept to a minimum. As the old age goes, you can spend a relative return. For example, if you have $100 in capital and sustain a 20% loss, you are left with 80. You must earn 25% return on 80 to return to the break even of 100%. Obviously, thinking about percentages, um, earlier you were risking 20% of $100, right? But now that your capital is 80%, you can't risk 20% of 100 again, because now you have to risk 20% on 80, which means that you have to make more money in order to just get back to break even. Okay, stock market industry sectors. Should the stock market become a potential favorite from the business cycle analysis above, the next step is to either go downstream to industries or groups and then to specific issues, or just start at the bottom with stocks and let the strength tell the investors where the opportunities lie. On the former method, some analysts have proposed theories of industry, group, and sector rotation during the stock market cycle. So, sector rotation is basically according to the environmental conditions and according to the economical business conditions, you can keep switching on the sectors where you are interested to invest in. Basically, you are rotating the particular sectors or industries in general. All right. Sector rotation. These rule definitions, however, are too strict, and often the markets do not accommodate them. For example, some models suggest that utilities, generally considered interest rate stocks, should be bought at certain stages. Okay. I'm just pausing it here. Please read this. All right. Where were we? However, we have seen, yeah. For example, some models suggest that utilities, generally considered interest related stock, should be bought at certain stages of the market cycle when interest rates are expected to decline. However, as we have seen previously, when an inflationary environment exists, anything to do with interest rates will generally underperform. In other words, any system of following specific models of business cycle is not flexible enough to account for changes in the major market segments. For some individuals like stock mutual fund managers, investments in the stock market is a requirement. In these instances, the best manner of screening out the most likely sectors to outperform is to use the ratio analysis between sector performance and the stock market as the whole. Okay, so this is a box and figure chart. Point and figure chart, and you know how to use the point and figure charts. Here you have a box size, and according to that, you're going to plot the same. This basically is a 3 point reversal, point and figure charts of ISHR US Dow Jones Utility Sector Index to the Dow Jones Industrial Average. Okay. So figure shows a 3 point reversal, point and figure plot of the Dow Jones energy sector to the Dow Jones industrial sector. Plotting the relative strength ratio of an industry and often a stock to some underlying average, we often see an irregular line that is difficult to interpret. By plotting these ratios in a point and figure chart, the minor, less significant oscillations are basically eliminated. Because of that, what happens is that the noise also comes down, and you can get a clearer relationship between the two. These charts are basically more informative than a line chart. Remember, however, when deciding whether to act on any of the ratio analysis, the absolute price action of the stock in the numerator must always be analyzed well. Okay, this is 3 point reversal, point and figure chart of the IYE and the Dow Jones Industrial Average. Okay, so now let's come to the bottom up approach. Okay, we saw what is the top down approach, right? So now let's see what is a bottom up approach. So for bottom up, you're starting right from down. So since you're starting from the bottom, you are starting directly from picking the stocks first, right? So at present, almost 8,000 stocks trade in the active stock market in the United States. This number is too large for an analyst to screen at frequent intervals. Yeah, so which is why we all make watch lists, and we are going to always have a watch list, and we are going to pick out trades, and we are going to see which one we are interested to trade, and we select and we only monitor few of them, right? It's not possible for us to monitor each and every move of all the 8,000 stocks in the market. Some technical analysts briefly inspect the chart of every stock in the universe using a bar, candlestick, or point and figure chart. This is a laborious process that's far from objective. Others screen through relative strength ratio charts. The least time consuming and the most objective method is to screen all stocks on a periodic basis for relative price strengths using one of the methods described. Relative strength provides evidence that a particular stock is outperforming the market and is likely in a strong upward trend. These methods have also been used successfully in mutual funds, ETF, etc. So there are various methods like these which we have discussed in order to select the stocks. The first method which we are going to see is relative strength. So we all know what is the relative strength, right? So first and foremost, whenever you see the relative strength method, the first thing that should come to your mind is that it is a bottom up method of selecting issues. Okay, and the second thing you need to know that it is also known as the ratio method. So if there is an MCQ saying that what is the ratio method in selecting stocks, then your answer should be the ratio method. Keep that in mind, alright? Okay. Most technical screening methods use a concept called relative strength to judge which securities have the most promise. Relative strength is a reliable concept that has been demonstrated academically and practically to have value. Indeed, because the method is so successful, it is primarily argument against the random walk and efficient mark hypothesis. The presumption behind the concept of relative strength is that the strength will continue similar to the way the trends will continue. And by doing that, you recognize the strongest strengths. An edge can be obtained by investing in them until their strength abates. If the strongest stocks remain strong, the market cannot be random or efficient. The most common means of establishing relative strength is called ratio method. It is merely the ratio between two investment sectors, industry groups, averages, commodities, and so on to see which is outperforming the other. Usually, a line chart is drawn that shows the item of interest, say a steel stock, and a ratio of the item to an average, say a steel industry average. If the line of the ratio is rising, it's simply showing that the particular stock is stronger than the industry average. So when stocks are stronger than their industry average, that means that they are performing really well in the industry, right? So interpretations of behavior are similar to those used in price and other oscillators. Divergence analysis, trend lines, and even patterns appear in the ratio lines. The item can also be plotted in point and figure chart along with the point and figure chart of the ratio, similar to what we had seen earlier. Okay, so this is how you understand what is a relative strength. You are basically seeing the relative strength. What do you mean by relative strength? The strength of the stock with related to the industry average, and using that you are going to identify which one is good for you. Okay. um, Not until 1993 was a major paper published on the subject of relative price strength or momentum, as it is commonly called. The paper, okay, this is talking about the paper, Jagadish Sitaram, demonstrated how stocks with high returns over a 3 to 12-month period earned excess profits of about 1% per month for the following year. However, they also found that these stocks on average had losses 13 to 60 months later, thus proposing the theory that relative price strength was not permanent but more likely a temporary phenomenon. They clearly stated that the t-test statistical evidence forced them to conclude that the hypothesis of market efficiency can be rejected even the most conservative levels of significance. So it's something which you can use on a shorter time frame or for a short term, but if you're going to take this approach for a long term, then you are not going to you're going to have negative returns on the stock since you held them for quite some time. In a study of 150 momentum and contrarian strategies, Conrad and Cole also found that the optimum profit occurred during the 3 to 12 month horizon. Again, that's what I said, that if during like the early period you need to book your profits. If you're going to hold it more than 3 to 12 months, then in that case what happens is that you might end up taking a loss even though earlier you were actually at a profit. Of course, other academics immediately criticized the study for any number of possible reasons, but by the time Conrad and Cole's paper, other doubts about market efficiency had also been demonstrated. Since then, the basis of their paper has been proven correct not only in foreign countries but in the period. Okay. Hmm. Other studies confirm the existence of profitability from relative strength in China, Germany, 8 different Asian markets. Academia has thus concluded that the theory of relative price strength shows success not only in producing profits but also in debunking part of the EMH. Various reasons have been proposed for the existence of relative strength, none of which has been proven. The most logical has to do with the behavioral tendencies of investors and the flow of information. An excellent discussion of the behavior model describing investor underaction and overreaction is Barr versus However, we are not concerned with why the relative strength is valid. Our only concern is that over a period of 3 to 6 months, using relative strength is a viable strategy, and that's a reliable means of selecting stocks. Okay. And then we have what is known as the measuring relative strength. So there are again various methods using which you can measure the relative strength, and in this chapter we are actually going to go ahead, and we are going to go and see various methods using which you can find the relative strength. But one thing you need to keep in mind is that the reason we are studying all the methods are because you need to identify and find out which of the method is suitable for you. For some person it might be the percentage change method, for some person it can be the alpha method, for some person it can be the levy method. So it really depends on your own method of trading and your own way of trading. So that is something you need to keep in mind. Okay, where were we? Yeah. So to begin with, let's talk about the percentage change method. Okay. So what is a percentage change method? In their study, Jagdish and Tietman used a 6-month price change as the basic look back calculation. Look back is the period over which relative strength price is calculated. The stocks that were sorted based on these rates of change, they found that the higher decile stocks continued to be strong for the next 3 to 10 months. The sample included both large caps as well as thinly caps and both high priced and low priced stocks. All performed similarly both in the original experiment and in subsequent out of the sample test. So I don't think there's anything to explain over here. Percentage change method is basically the percentage of the price change they took, and here the timing which they took was 6-month period. So they basically, their look back period was basically a 6-month period, and they used the price change based on the 6 months data, and then they saw that whenever that happens and whenever the stocks were sorted based on this, they were basically strong for the next 3 to 10 months. So that is the percentage change method. Let's now move on to alpha method. Now what is alpha method? Let's talk about that. Alpha method, a number of different methods of calculating relative strength have been developed. One is the alpha method. In the beta theory of modern portfolio theory, stock prices are compared with an average, usually the S&P 500 weekly over a year, and sometimes with different time intervals and periods. The weekly percentage change in the stock market is plotted versus the weekly percentage change in the S&P 500, and the linear regression line is drawn through these plots on the best fit basis. The line so defined is expressed using the slope of the line called the beta and the intercept with a vertical axis called the alpha. So beta is the slope and the intercept is basically the alpha. Traditionally, beta has been used as a measure of volatility relative to the S&P 500 and considered a definition of market risk. Stocks that have a steep slope in the regression line and have high beta demonstrate pro- a proclivity to have higher gains than the S&P 500 when the market is higher, but also larger losses than S&P 500 when the market is lower. Why? Because the beta is high. When you say the beta is high, that means that the volatility is high. So when the stocks had high beta, then they would give you higher gains as compared to the industry, which is the S&P 500 index. But when the S&P 500 was crashing now, even during that time the stock used to give you bigger loss as compared to the loss which you would have taken on the S&P 500. So that is because these stocks have a high beta. Now let's talk about what is alpha. Alpha is again the intercept. Okay, you need to keep that in mind, that you are basically taking two values, the industry and the stock, and then you are plotting the best fit using regression analysis and regression line. And after you do that, after you mark the best fit line, whatever will be the slope, that is going to be the beta or the volatility, and whatever will be the intercept on the vertical axis or the y-axis, that is basically going to be the alpha. So high beta stocks would obviously be more profitable, but they'll also be more risky. What they missed is that high beta stocks could also have negative alphas, suggesting that although more volatile, their trends relative to the S&P could be downward. In MPT, the alpha must always either approach to or be close to zero itself, because in theory, no systematic gain can come from the market. In other words, a stock's price motion is determined by beta, not alpha. Alpha is not considered of any importance. However, in actual markets, alpha does not remain at the zero level, and thus measures how much better or worse a stock is performing in relation to the S&P. When alpha is compared among stocks, it provides a relative strength measure, and a stock list can be made according to alpha, which shows which issues are strongest. Alpha will change more frequently and more widely than beta, but beta is somewhat irrelevant to the relative price strength and has been largely discarded. A higher alpha would mean that there is a higher correlation with the S&P 500. A lower alpha would mean that there is a low correlation between it and the um, index stock and the index. So this, you can look at this. Beta is the slope, we have discussed that, and you know what is formula of slope is. And what is alpha? Alpha is the y-intercept, and you can see in this case it is a little above 1, so which is why the alpha is 1.55. So the first thing which we saw was the percentage change method, in that you took a 6-week look back period, and then we saw the alpha method, in which is also in the MPT or the modern portfolio theory. So this now let's come to the trend slope method. So now what is a trend slope method? Rather than go through the more complicated calculation of alpha and beta, another method of screening for relative price strength is to calculate the slope of the price curve in percentage terms over a specified period through a linear regression formula for each stock. The stocks can then be ranked by the slopes of their price curves. This method is similar to the alpha method and to the Jagdish and Titman method. It is easier to calculate than the alpha method and does not suffer from the drop off effect and the rate of change calculation. So what do you do in this particular method is that you first okay, let me just actually write it down so that it's easier for you. One sec. Okay, so the first thing which you are going to do is to calculate the slope. Why am I not able to use this? Okay, so the first thing which you are going to do in the trend slope method, like the name says, you are going to calculate the slope of the price curve in percentage terms. Okay, slope of the price curve in percentage terms over whatever specified period they have given you using the linear regression formula. And then what you're going to do is that the stocks can be ranked by the slopes of their price curves. So, and then according to the ranks, you can basically make a watch list for yourself and select the stocks which you want to trade in. So this, the biggest advantage in a trend slope method is that there is no drop off effect. I'm not going over the drop off effect because you know what a drop off effect is. So that is trend slope method. Moving on to the last one, we have the Levy method. So Robert Levy introduced a method of calculating relative strength in his 1965 paper. Levy first calculated the ratio of the stock's current price to its 131-day moving average. So in Levy method, the first thing is you have a ratio of the stock's current price to its 131 trading moving average. He then, okay, why am I saying trading day? Because obviously there's no weekends in the charts, right? That's why. Levy found, as did Jagdish and Titman later, that the screen for relative strength should be calculated in the performance of the stock over a 6-month look back period. Anything shorter tended to give multiple whipsaws in post calculation performance, and anything longer tend to be too close when the performance began to regress back to its mean. Levy also found that when the overall stock market headed downward into a lengthy bear market, relative strength continued to be reliable but gradually lost its ability to pick winning stocks. Alright, so what is Levy method? you are calculating the ratio between the stock's price to its 131 day moving average, and according to that you are ranking it. That's it. So let's quickly just see, it's so simple. This chapter is actually simple. Yes, it's a very long video and it did take us a while, but if you're actually listening to the videos and you're trying to learn the concepts along with watching the video and making notes, then it's actually not difficult. So you have various methods of measuring relative strength. The first thing is a percentage change method. Here the look back period is a 6-week period and you are going to calculate the price change. And then we have the alpha method, and in alpha method what happens is that it is a concept of MPT, and you are going to find the relationship between the stock and the S&P 500, and you are going to see what beta is. Beta is the slope and alpha is the y-intercept. Yeah, and a regression line is being plotted and so on. And then we have a trend slope method. In the trend slope method you are basically not being a victim to the drop off effect, and here you are going to find the slope of the price curves in percentage terms and you are going to rank it. And then you have the Levy method where you calculate the ratio of the stock's current price with the 131 day moving average.